Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
So we are on expiration day, couple of days left for the month to close, and in fact almost a week. I think next Wednesday will be the August closing. But between now and then, what we are really getting post expiry is a 90-point premium in the futures, Nifty futures for September compared to August. And this has been there all week long, so it's not like a one-day spike. And what does this really mean? Because this is the highest reading since we had the top in April, the 4th of April, 8th of April around. The data shows on my chart because we actually change our data only after expiry, but usually logically, because that's how the system mathematically does it. I would like to actually, if I had my own data sheet, I would change it 1 week before expiration, because by that point of time, the basis really goes to zero for the current month. So, when you're plotting data, you don't want to look at last month. And if I do that, then it will actually show up in terms of a big deviation. So what this really means is when you get extremes, like you get a huge discount in the Nifty premium, so you get a huge premium in the Nifty, basis basically. I should not say premium, that's the basis. So if the basis is at a discount, huge discount is extreme negative, a lot of shorts in the market. And if it's a premium, then a lot of longs in the market. Now, of course, when you say open interest, it's equal longs and equal shorts. So why does this basis really show up? That should be the central question to anybody who understands the way open interest is really generated. And that is where the whole answer becomes behavioral in nature. And so you have to understand that markets and price is always behavioral. People try to look at cash market buying of FIs and determine whether the market will go up or down, when that doesn't really matter, because for every buyer there is a seller. What matters is that you're willing to pay a higher and higher price, and somebody is willing to sell at a higher price. So the perception is that a higher price is good or correct, and that perception is what really drives markets. And similarly, in the futures market, open interest may be flat. I mean, it's equal longs versus equal shorts, but you're getting a premium or a discount because there are arbitrages, there are rollovers happening from current month to next month. So more longs are rolling over than shorts, and they're paying a premium to do so. And that premium shows up as excessive bullishness. So it's really a sentiment indicator. It tells you that people are excessively bullish at this point of time, willing to roll over longs even at a 90 basis points premium. Simply because it's been a run, for the last 2 months since the bottom in June, it's been a massive 2000 point rally, and the confidence is relatively high. Now, of course, that can result in two things. One is you can say, okay, it will just pause, you'll get a consolidation, premiums will pull back a bit, and the bull run will go on. If it's a bull market, that's what you would usually end up seeing. But if you're in a bear market, you get a trend reversal. Now, that's of course the bigger call that we're really trying to take over here. Versus a lot of the street. Interesting, since I did the spaces day before night, so many people have DM'd me telling me, one is about the fear of missing out. That has been one of the big questions. Markets rally 2000 points. What do we do now? What if we miss out on this bull run? My answer is, why did you miss 2000 points? First of all, it was similar to these extreme readings that we are getting right now in terms of premiums. You were also at a discount. Not just that, I have highlighted it on Twitter. Since we were at 15,200, that FIs were extremely short to the extent of similar as they were in March 2020. And so I use that as an extreme data that if there's a lot of shorts in the market, which shows up in the discount in the Nifty premiums, it results in a short covering rally. And so you ended up getting one of the best short covering rallies of last 2 months. The FOMO is if you didn't participate. I participated, but now as readings are reaching the other extreme, I prefer to get out and sit back and wait and watch what is happening rather than feel this fear. Because if market's going to 19,000, I can always get in the next 500 points. But the point is, if it's going to roll over, you don't want to get stuck. That is how I approach it. You may or may not approach it that way. If I had confidence, like I did throughout 2020 and 21, there was no thoughts of negativity. I was always perma bullish. People thought I was the perma bull, not having seen my past record of 2018-19 when I was always on the other side. So you have to change with what the market data and sentiment and macro situation is showing. Right now, the macro situation has not changed over the last 6 months, which is why I'll continue to use this as a long short market. When I say a long short market, means it will fall thousands of points, rally several points, then again fall, retrace. And that pattern will probably go on it's gone on for the last 9 months now. The big bet is it going to continue that way? I still think it might, and if it changes, I'll probably recognize it. Right now, I'm not able to see reasons why it should change, and therefore, I'm trying to stick to the same methodology that should have worked over the last 9 months, which means extrapolating it into the future, that it will continue to work that way because things like the currency are still weakening. The USD INR is still showing strength, which means the rupee is weakening, of course, and rates are going to continue to rise. The tightening exercise from the US, that is the Fed's quantitative tightening program, actually will expand from $45 billion to $95 billion a month from the first week or second week of September, and that's going to be a huge jump in terms of how much they're going to be cutting back in terms of their liquidity supply to the market. So all of these things are happening in the backdrop. People are hoping to hear something from Jeremy Powell tonight at the Jackson Hole meeting and get clues as to whether they will change this policy stance. And it doesn't have to be. He may say something, he may not say something. Many such meetings go without any comments or minimal comments, which people then try to tweak and read into that this is what they might mean. If he says something meaningful, it will create a market reaction. If not, the market will just continue to move on what is already known information. That is, they cannot really change the trajectory of what they're doing. They may try to slow down based on data. He said in the last meeting, we'll be data dependent. And now people are trying to figure out what that really means. But coming back to all this, within this backdrop, as nothing changes, the only tool we have in our hands is market data, and which is why I pointed out the Nifty futures premium. Another thing which you can check on is the FI positioning itself, which was extreme short. By the end of last month, expiration, all shorts had been cut. Throughout month of August, even though FIs are buying in the cash market, which I said is not the most meaningful way in which you can really forecast anything, because that data has never really helped from a forecasting point of view. The futures market, they have not been buyers. So after expiry of last month, the net position was 50,000 contracts long. And then for the rest of the month, it's been dwindling between 10 and 20, up, down, up, down, up, down. And actually in the last 4 days, it went short. And so that is actually a reversal in the position. And that is where I think basically on the future side, they're not really taking a big bet. The cash positions will really reflect, global cash flows, because money just gets allocated and then you make a country allocation and you end up getting positive flows. So those are things which you cannot control and correlate with, because for every buying that FIs do in the cash market, you have DIs selling, and when DIs were buying, FIs were selling. And so that matchmaking doesn't really tell you anything about the liquidity supply. What is going to be critical is the positioning, because liquidity at a global level continues to be in a tightening mode. So that's, I think, my overall take on what is happening. And of course, I'll discuss many other sentiment data points in the long short report, which I'm going to publish in the next 2 days. And if you haven't heard the Spaces event, already it's gone pretty viral. I think 46,000 views, and you can just go to Twitter and see it's in 2 parts. Because there were a lot of issues with Twitter, I think mostly related to Android phones, because I ran the Spaces from Android. It used to happen many months ago, and then I switched to Apple, and it used to be very stable. I'll probably have to do that next time. But the recording is there, and so if you couldn't hear it clearly, I think you will be able to do that on Twitter. So that's where it is. The weekend with Indiacharts will follow tomorrow, and our market outlook, as stated in many of my interviews and posts that have gone over the last 1 week, is that we've reached one peak. We are at a point where we're going to decide if things can get better, but my outlook is that things probably get worse before they get better, which means most probably we've topped at 17,992 and are heading down from here. And the pendulum has shifted from everybody being bearish to a lot of people being bullish, which is what the futures premium is also indicating and adding. And that is what I would like to depend on, rather than the 5 people that you speak to. Because when anybody comes up and says that there was another Twitter debate, you think that everybody's bearish. A lot of people are telling me everybody's bearish and therefore market will keep going up. And I say, look at the data. If you can prove that to me with the data, I'll accept it. And the data says otherwise. And so the right thing to do at 15,200 was look at the data, and everybody was bearish. Right now, that's not the scenario. Even though it may appear so, people who are my followers will tend to be so because they're listening to what I am saying. But broadly, the market says something else. And that's what I will go by right now. And it's a pretty good active debate, because I can see a lot of people coming up on my post and saying, no, this time it's going to go to 19K and 20K. And that's the kind of debate I would like to have. Even on the spaces, there was a good debate with one technician jumping in. We could have had many more. I would have wanted even some fundamental opinions on the other side of how things are going to pan out. That would have helped. And not to say that I don't believe in the idea that India's macros are good and the debt levels for corporates have come down and cash flows are better. But what we are being driven by sometimes as markets are always a combination of two things, which is earnings and liquidity. So while the earnings can be the long-term growth trajectory for a market, you have liquidity cycles. Excessive leverage comes in a particular market, creates a peak, then it unwinds, then there's an unwinding cycle, and then again another build-up cycle happens. Now this can happen in different levels. Like I said, leverage means which is direct into equity, and what we are facing today is excessive liquidity in the economy itself, which is what is creating the inflation problem. So one way or the other, somewhere there's an excess and then it contracts. So there's always this liquidity cycle in the economy, and that then ends up driving the near-term trends, which is what we say the medium-term trends, or in interim cycles between even a growth phase. So even if you go back to 2008, the great financial crisis, you will find that the Indian economy was still growing at 7%. So why did the market fall by 80%? It's because global liquidity tightened and there was a financial problem. And so that's what we are trying to pay attention to right now, whether there are other problems that can, bring down the market and that can lead to lower valuations. And at that point of time, really, the growth data and the positive factors which we can list out tend to get ignored by the market, but they're important. They're important because when you get that sell off, that's where the opportunities exist. So that's the way to keep yourself tuned to where you're going to look for opportunities, but to not pay attention to what is happening in the market and the liquidity cycles can actually push you to sit through drawdowns. And if you're okay with that, fine. But if you like to be an active manager of your portfolio and avoid these drawdowns, then you'd want to pay attention to the data points that I discuss, and I will go into greater detail in the upcoming long short report. So that's all for me for today in this market wrap up, as we are ending this month's expiration on the 25th of August 2022. Thank you.